Hi everyone, Happy New Year wishes to you all. Today I'm going to take a quick training on insurable interest in PNC insurance. By definition, insurable interest exists when an insured person derives the financial or any other kind of benefit from the continuous existence of the insured object, which means if you want an insurance policy for any property or person, then you need to prove that you have some kind of financial interest in that property. For example, if you need homeowners policy, you need to prove that you have a financial interest in that property. You cannot go to an insurance company and say that I need an insurance policy for my neighbor's home, which means they will decline the policy. Similarly, you cannot say that I am planning to buy a car after 2 months. Give me an insurance policy upfront. No, they are not going to give you. The only way you can get your insurance is you need to prove that you have some kind of financial interest with that property. So, second thing is why do you need to prove insurable interest? That's what we are going to talk about, pure risk versus speculative risk. Pure risk is nothing but the risk that is out of human control. So most of the time, PNC insurance policies comes under this category, pure risk, where you can have only loss and you cannot have any kind of profit from the insurance. Whereas speculative risk is more of no voluntary effect from the customers, which can either result in a profit or loss. A very good example is gambling. When you are involved in gambling, sometimes you can be at loss, sometimes you can get profit. So the insurance companies are not going to insure something of this sort. So to avoid this speculative risk, they have this insurable interest concept where they don't want you to go to some random property in your neighborhood and then make insurance for that property and then in the future create a fraudulent claim to get some kind of profit. So that is why we do have this concept of insurable interest. Now, the happy path is I have a customer, I have my home, I am the primary named insured. And in certain scenarios, you can have additional insureds who have an insurable interest on the property. Say a bank who have lended you some money when you bought your property. So they can be added as additional insureds. The primary difference between primary named insureds and additional insureds is the primary named insured alone can request for a policy change or a cancellation of that sort, whereas additional insureds can only make a claim payment for the level of insurable interest that they have on a property. For example, if the property is 800k and the additional insured mortgage bank have provided you loan for 400k, then they have insurable interest only for that 400k. The final point I wanted to make it clear is, as a customer, you need to prove your insurable interest both at the time of application and at the time of loss. When you make a claim payment, you still need to prove that you have a financial obligation with that property. You cannot buy a property during the application or during the process of getting the policy and then sell it after 2 months and then make a claim payment after 3 months. At the time of application and at the time of loss, you need to prove that you have an insurable interest with that property or person. Let's see some quick examples. The first example is you need insurance for your home and personal property. Yes, you do have insurable interest. Second example, you need an insurance for your car that you plan to buy after 2 months. No, you cannot prove insurable interest in this scenario. Third example, you have a mortgage company that have provided you 500k loan when you bought a new home for that's worth of 800k. Then the mortgage company has an insurable interest only for 500k. Fourth example, four people joined together and they formed a company which is worth 1 million and then they got an insurance policy. Then each partner will have insurable interest only for 25k. The fifth example, Bailey, which means a dry cleaning company have got your clothes for dry cleaning and they have insurable interest because if something happens to your clothes, they have some financial obligations. So these are the quick examples I would like to go through. I hope you like my training videos. If you like my training videos, please do subscribe to my YouTube channel. Have a great day. Bye bye.